All right, I think we're going to start. So good morning, everyone, and welcome. Thank you for joining us for this Investor Forum for Professional and Business Services. It is a pleasure to bring together investors, corporate ventures, funders, and partners to explore the investment opportunities emerging across PBS, as well as the wider capital deployment needed to support UK growth. So why does this sector matter? Well, as we know, the UK is a global leader in high-value services. The sector contributes around £300 billion to the UK economy and supports almost 1 in every 7 jobs. Now it is entering a new phase shaped by AI and data technologies. Across legal services, accountancy and consulting, firms are automating routine work, improving decision-making, redesigning delivery, and creating more scalable business models. There is a shift from traditional services towards technology-enabled services with greater potential to scale. As the technology develops, it is also likely to create new demand for legal governance and assurance expertise around trust, accountability, risk, and oversight. Investment in the sector is growing. In legal tech alone, UK investment reached a record of £188 million in 2025, 35% up on the previous year. So what is government doing to support this sector? Innovate UK and the Economic and Social Research Council have been backing innovation in this space since 2018 through a dedicated program and network. This sector is now recognized by government as one of the 8 growth sectors in its industrial strategy. The PBS sector plan includes a £150 million commitment, and UKRI has confirmed its budget allocation, £118 million for professional business and financial services over the next 5 years. What do we want to achieve today? So today is especially timely, following the launch of Innovate UK's new strategy last week. It's focused on turning breakthrough ideas into industry giants through stronger scale and investment pathways, speaks directly to the purpose of today. Our aim is to explore how innovation in PBS becomes more visible, more investable, and more scalable. By bringing together sector specialists with deep tech and B2B SaaS investors, we can exchange perspectives on the opportunity emerging across the markets, the barriers that remain, and the connections needed to support growth. I hope you find today insightful, practical, and rich of valuable conversations and connections. May I now introduce Sebastien Paillet, CEO of ScaleX.
Thank you very much, Astrid. I'm sorry for you, but as you can hear from my accent, I'm French and I forgot my sunglasses. But today is not to talk about style, it's to talk about investment in the UK. So as a quick introduction, so I'm Sebastien Paillet, the CEO of ScaleX Invest. ScaleX Invest is a platform where we help investors to monitor and value their portfolio. So as you can understand, today is quite hectic with all what's happening with AI and SaaS, but that's where we try to give some guidance to the market to better monitor the NAV. But I won't stay too long about ScaleX because today is more to talk about the ecosystem in the UK, especially the business and professional services. As mentioned by Astrid, it's a key sector of activity here in the UK. It contributed more or less to 281 billion to the UK economy, and the figure that I think is the most interesting one is the 5 million of people that are working in this sector of activity. And I think that's the purpose of the event today, because with all what we see with AI and the transformation of any kind of industry, I think this one might be one of the most impacted by the innovation. And that's the purpose of today also, is to link that with the innovation, because I think the UK ecosystem is quite attractive for innovative business. In 2024, more or less 9 billion has been invested in the UK investment, and it represented more or less 9,000 companies were backed in 2024, which is quite important. And those businesses will be mainly the ones that are going to compete the traditional businesses in the business and professional services. So I think that's quite interesting to link those two ecosystems today. But there are some challenges, as you can imagine, with what I say with innovation. We are in a moment in the economy that is quite interesting because, as you probably heard, it's quite difficult today to raise capital for innovation. Okay, we have the AI in one side, the rest of the innovation in the other side, and what we've seen is that the trend of the valuation multiple has decreased over the last 2 years. I would say in average, sorry, there is a typo here, but it's minus 43%. Is the evolution of the multiple we've seen in the tech industry over the last 2 years. So we see that we are at a curving point where we want to innovate. It will be key to innovate, but we need to back those companies to succeed, especially if we want to keep it sustainable in the economy. However, saying that, we see that there are two important trends. One is I would say the past innovation, I would call it, the SaaS industry, where we see that the multiple average is 6.5x the revenue, and it's totally the AI is going very high with almost 12x the revenue multiple. Saying that, I think it showed how the world is going to be polarized between the historical industry and the new industry pushed by AI. So it will be very important today, I think, to discuss about all those topics, how we can mobilize capital to invest in innovation, because definitely this sector is going to be disrupted in the next year by AI. And if we want to make it sustainable for the local economy, it will be important to find a good path to invest in this sector. I won't be longer. I will leave the floor to the last panel. As a last, we say, more commercial slide, so we publish half-year index of valuation multiples in the tech industry. So if you want to have access to it, we are going to publish one in April. That's it for me. Thank you very much for Astrid and all the Innovate UK team to partner with us with this event. We are very proud, and we hope that you will have a lot of interesting learning, and we are very proud also of the panels that we managed to bring today. Thank you very much.
Yeah, I don't like the photo, but anyways, that's so the first. So hi, my name is Martinoff, and our first panel will build on these remarks, and we'll try to map kind of the space and try to pick up some of these kind of different trends and challenges. So we had initial conversations last week. And there were already some I think tensions and provocations that emerged, which I think quite valid for this discussion. So, and again, the idea for the panel sessions are not necessarily to be a Q&A, even though I have a list of probably easily fill a couple hours of questions. So it's a conversation, and we'll start the conversation now, and later we'll have a lot of networking sessions that we all can participate and ask questions. So here we have a quite intentionally quite diverse panel, from established venture capitalist to pioneer in legal tech, to growth specialists kind of in government and scale up to so I want to start with the first question in a way to give a sense, everyone to kind of introduce themselves, and basically to ask the question why PBS sectors are interesting for investors kind of right now, and how do we see kind of from all these four different kind of perspectives what the challenges and the opportunities. And maybe Shruti, we can start with you, and especially that
just
one microphone at a time. That's the rule. Okay,
good.
Are you going to play music? You're not going to play music, so I can stop talking, right, at some point? So from your perspective, and especially the way you have evolved and developing not just investing in deep tech, but also you developed and reimagine your firm as a service company. Can you bring kind of your perspective on why now, and what's the momentum that we see in the sectors?
Yes, sure. So first of all, thanks for having me. So my name is Sebastien. I'm the managing director of Soprasteria Venture, which is actually the strategic partnership and investment arm of the group, so Soprasteria. So what is Soprasteria? It's a big service company. So it's one of the IT leaders, European leader, so with 50,000 people around. And what we do basically is between software engineering, integration, and consulting. So that's one of the main reasons, where we can see, our next transformation. Right. So our aim is by 2028 to generate more than 60% of our offers, our revenues from what we call new generative offers. And what does it mean? It means end-to-end offers. So transforming from consulting services, so just adding in people and time, to something that's end-to-end. And when we call end-to-end, that's with IP and tech transformation. So back 5 years ago, to just get along with our clients, first of all, we start with digital transformations, but now it comes down to AI transformation. And it's not only about adding on people. So why now? It's quite, we know that we need to transform because it's not anymore about selling people. There's innovation out there, and which Soprasteria Ventures is actually trying to make the bridge between these startups and these amounts of ecosystems and startups that are out there that are competitors, that are going to be competitors. And actually, the third point is AI. We all know AI. And the past 2 years, we basically know that either from a generational, foundational model in AI, and we know that verticalized AI in services are coming in. We've all heard about Claude, Anthropic, and we know they are coming for us, basically.
Thank you. And Shruti, I said you're kind of pioneer, but also in a way a veteran, because you launched Fusion like 6, 7, 8 years ago. In a way, it was quite early bet on technology for legal professions. So how do you see, kind of from your journey, the appetite kind of changing? And what's basically, again, going back to and building on the thinking about the momentum right now?
Martin, that was very gallant of you to point out how old I am in such a public forum. So thanks for that. That's an amazing way to start my Monday morning. Really appreciate that. Just sort of by way of background, I work at Shearman, so one of the biggest global law firms in the world. And 10 years ago, we started Fuse. The idea really then was that we would find a way to engage with legal tech companies that would help us to work better. And back then, the ecosystem of legal tech companies was about sort of 6 people who were working in their garages with a dog, and who had left the law because they found their jobs a bit rubbish and wanted to do it better. And so actually now really has been a sort of a really interesting year for me, because it's so amazing to see that we're finally at a point where all law firms everywhere, kind of regardless of their size, are starting to engage with at least the discussion that they need to use technology to become better and faster. So I think you were just asking around a bit about how much it's changed and why. When I first started, legal tech was kind of a side sport. It wasn't a necessity. You would do it because you were interested. You could do it if you were a law firm that was big enough to invest in experimentation. You could do it if you had somewhere in your DNA an idea that you would work differently. And I think actually what has changed completely is the client expectation. And the thing that I think will continue to drive change is the fact that our clients are now starting to buy legal tech themselves. And so what I'm already seeing this year is mandates that we previously would have got, big mandates, they're no longer coming our way, because actually in-house counsel are taking more of the work themselves, and they're taking a different slice of the pie themselves, and the work that they expect us to do already is very different. And the tension, I think, for a law firm is understanding that it's not just about us using and deploying legal tech to do the work that we've already done, because in truth, the work that we've already been doing for many, many years, that's not going to come our way anymore. It's going to stay in-house, and the work that we'll need to do will be very different.
That's really interesting. I mean, we had similar conversations with a number of firms, the Legal Tech Forum kind of last couple of weeks ago. And kind of one of the reasons why we Innovate UK are here is because, as Astrid said, this is some of the key priority sectors for the government. So Katie, because you have quite interesting experience both within government but also in the city. So from your vantage point, I mean, do you see that deal flow matching the conversation? I mean, what's your perspective on what's happening in the sectors?
So I'd say yes and no. To introduce myself, I'm Katie Ramsey. I'm head of the Venture Capital Unit in the Office for Investment in Government. And prior to that role, I was 2 years as head of FinTech. So I've certainly got a good vantage point in terms of what I believe is coming, and that, you know, headlines, commentary and stats seem to back up that PBS, professional business services, will be seeing its fintech moment. I don't think we're there yet in terms of the size of the opportunity, and depending on which metrics you use, something like 900 billion globally is the size of the opportunity, or the size of the legal services market, and that's a trillion. It's multi-trillions when you include wider professional and business services like consulting, HR and other functions. So the size of the opportunity is massive. The amount of funding that we're seeing into the sector is a lot smaller compared to other sectors that are dominating. So for legal tech, globally it's roundabout valued at, in terms of venture funding, about 1.5 billion to 3 billion. For the wider PBS sector, it's 15 to 25 billion, which is a huge range if you think about it. And we see varying levels of funding in the UK. We're super successful compared to the rest of Europe. We're a leading destination for investment in services. But do I think we're seeing the full fintech, life sciences, AI wave that has really transformed those sectors in PBS yet? No, but that does present an opportunity. I think we're not seeing the mega funding rounds yet. Other sectors dominate at the moment funding, and it can change quite relatively quickly. But given everything that's going on geopolitically, I'm seeing a huge amount of fundraising in defence, in security, which is absolutely understandable, and therefore PBS wouldn't be getting the headlines. I think there's also potentially a visibility, I wouldn't say a problem, but a visibility gap, if you like, in terms of to clear investment hurdles for professional and business services. Investors can absolutely identify an opportunity, but does it represent a scalable proposition? It's hours heavy. Does it have like a protectable moat? I guess a moat is protected. Does it have a moat? And so there's questions around those, and therefore often it'll be reclassified as an investment to clear those hurdles in as a tech investment. So, for example, if you had an expenses management system, it's enterprise scale. It's serving expense management, which could be an HR function, could be an accounting function in a company, but it would be repackaged as an AI investment or a SaaS investment. So I think there's a gap there. Because I could talk at length about this, I think that presents a bit of a balance. It shows that I'm not convinced yet, or VC perhaps isn't quite convinced. It's not at convincing levels yet of, say, a fintech sector, but I think that actually just shows that the opportunity is there, and once it comes, hopefully all of you will be benefiting.
Thanks, Katie. And speaking about filling gaps, so Xavier, so you I mean, you provide quite significant amount of loans, so say for scales ups, and actually fill a very, I think, important gap. So, what do you see from your perspective, from kind of where you stand, and what's happening in the sectors right now?
Yeah, just by way of background, I'm Xavier Van Hove, the managing partner of Nighthawk, which is a venture debt lender in the UK. So we're both a user of professional, a heavy user. We pay for far too much in legal fees on every deal of professional business services, and also an investor in professional PBS. I can't say that word for some reason. There's really, I mean, I'm going to slice it slightly, right? In accounting, I think that the sector is already very, very heavily penetrated, right? You've got Xero and QuickBook have dominated the scale. You know, we have hundreds of clients, and they, you know, Xero and QuickBooks are 95% of our accounting platform. Oracle is another 3%. So that's already very heavily. That kind of points the way, I think, and slightly to your point, which is you are seeing the work that the accountants and the auditors do has changed dramatically over the last 10 years, right? And for us, it makes life a lot simpler in that, you know, we can access the client's accounts online. It's fully integrated in our platform. We can see, you know, things are flagged automatically. It's made everybody's workload much lighter on the lending side. It's made the client's costs a lot lower. Most of our businesses don't have an in-house accountant until they get to probably about 100 employees at least. And so that has already changed. That's probably the one that is the furthest along. And in fact, if you look at the Xero, which is a New Zealand company, it's highly valuable, it's quoted, and so on and so forth, and has been for, I think, 2 decades. If we look at the other side of the spectrum, legals, Seeds Legal, I'm sure we've all heard of. A lot of startups use them, but we are still at the point where AI hallucination terrifies the hell out of me. And so I will use ChatGPT or Claude to review an NDA because I don't, I care that it's fair, but I don't need a lawyer to review it. But beyond that, I think we are not yet at the point where there is any faith or trust that you could not rely on a lawyer. I think that is candidly at least a decade away till we're at that point, but I know some inroads are being made. Also, very candidly, we've not seen any opportunities to invest in any of those, though we would be very interested. And then beyond that, on the IT side and so on and so forth, there is a lot of disruption with AI. Certainly, what I would say is generally misunderstood is that very large companies have their processes incredibly well built, and they're already fully integrated. And I don't know that AI can add that much to very large companies. It does add, it is a massive multiplier for small businesses who can't necessarily afford the people needed to optimize the system, but the AI will do it for them.
Am I allowed to just quickly come back on the legal thing, if that's all right? Sorry, I'm disrupting
as long as
now,
you're
chaos.
provocative and disruptive, yes.
No, but just to make the point, I suppose, from the vantage point at which I sit, which is that of our clients tend to be the largest financial institutions and largest corporates in the world, and we are, as I mentioned, like a big global law firm. So from the vantage point from which I sit, it's interesting because almost everybody is either using, trying, or talking about Harvey or Legora, and it sort of seems to have become, the rhetoric around legal tech seems to have sort of transmorphed into this weird two-man race, sort of similar to what you're describing in accounting, but very, very quickly out the doors. And I think what's been interesting for me to see is that there's not that much space around those two, even though there is plenty of space in terms of the processes and the work and the skill set that's not currently yet being tackled. But because lawyers are generally quite risk averse, and to your point around hallucinations, I think that, you know, we spent probably the first 2 years of this whole thing sort of being like, oh no, we can't use AI, or others did. We didn't actually, but others did. It was quite difficult to sort of bring the horse to water in terms of like the industry. But I do think that has really, really changed. I definitely think in big law, at least, there is almost nobody who isn't using some form of wrapper, so typically not a ChatGPT but a Harvey or a Lagora or something, because if nothing else, the client expectation has just changed so dramatically that in almost every RFP that I respond to now, I'm being asked, what legal tech are you using, and what efficiency gains should I expect to be able to see as a result? So I be more positive.
Does that mean we get lower fees?
I asked for that.
No, that is speaking to a smaller company the other week, and it was concerning of they're just automatically asked to price in what's our AI price reduction, and so that I do think is a massive, massive concern for the industry, and I don't know what the answer to that is, except for I know that some things I've done, I've tested and put into those, you know, how much of this was written by AI, and I put in something that I absolutely wrote, and it said it was like 72% AI. So I don't know what that says about me and my style, but yeah.
I mean, this is really interesting. And can we, because as Astrid said, one of the kind of part of the new strategy of Innovate UK is exactly to support and kind of build kind of giants. So from your perspective, when you think about what are the opportunities for investors in the sector, so what are the characteristics for the businesses you land, or the businesses you want to scale up, or I mean, I think Shruti, even within I think you have 70 or 80% of startups of alumni have been kind of work within your firm. So what good looks like when you think about choosing which companies are most promising? Kind of what are the opportunities within the sectors?
I mean, for us, we've just done our selection round. So every year we open up a selection process to legal tech companies around the world. We had 315 applicants this year from, I think it was 53 countries for about 6 spots. So we've sort of just done that process. We shortlisted 30 to see it in person, and haven't quite narrowed that down yet. That's today's job. But actually, law is a difficult one because it does require, I think, to do well, it does require an element of subject matter expertise. So for us, what we're looking for is not just a tool that makes sense, that sounds good on paper, because we see a lot of that, but you have to actually understand the organisations into which you will be slotting. So you have to understand like just basic things like where we store our documents, how we manage our data, what our client confidentiality requirements are. Because sometimes, and we've seen this, I just saw this over our selection days, you can have the best idea in the world using the most advanced technology and it can work beautifully, but if my information security guy says no, that's just it's dead. And I do think like law firms are particularly risk averse, as well we should be, about trying new things. And so we barely ever even get off the ground. If you're not set up in such a way that you understand the infrastructure of a law firm, then you won't even get like slightly off the ground, and you'll never ever get anything under your belt enough to even prove any elements of success. So I think there needs to be an understanding of the infrastructure of a firm into which you want to slot in order for you to be able to even just start to gain some ground. Does that make sense? Yeah.
Where do you see like most value created?
Well, as investor, I mean, currently, it's quite difficult to say, to be very honest. I mean, everything dropped the day that just Claude announced that actually, they could just do contract management. They could enter into legal and stuff like that. And why am I saying that? Is that because you've got the Harveys of these worlds, and we know that in the US they've been funded major money, and in a little instance you don't know whether these 300 or 400 millions worth of funding were worth it. That's the time where we are in. So as an investor, my question now is whether the foundational models such as Anthropic are going after, verticals, so specialist verticals such as accounting, finance, typical finance and legal. And what would happen, or what will happen to all this new company based on the AI, on this foundation model, which is an instance which has raised money the past 2-3 years, like Harvest, that are potentially, just not saying dead, but potentially they are going to be competing versus large foundational models with billions of funding. So that's a question. And what we saw is actually, because Sebastien talked about it, was actually multiples on the AI. And we were seeing a year ago valuation that could go up to 30. If you go to the defense, 300. So there was ridiculous types of multiples. And what we're seeing is that these AI companies might be coming down to the SaaS multiples that we're seeing. And that these SaaS multiples, so on professional services, might come down to the professional services multiples, which are close to 1. So this is a timing where it's quite difficult for, let's say, legacies of people, that we could be potentially, right, saying, do we need to get in? And if we need to get in, how do we get in at the right price? Or is there a price? So as an investor, it's quite, I'd say, a nice moment to be in. So to be in positively, because you can actually hedge your bets on going either way. On our side, what we call the SaaS apocalypse, and most of the SaaS apocalypse that has been over the news past 2 months, the reality is we know that there might be only 60% of these SaaS that will be impacted, and only within 5 to 6 use cases. Okay. Unluckily, on these use cases, legal are one, accountings are one, software engineering is one, customer services are one. So they're basically professional business services, right? But what we know is the people that will win are actually the ones that are deep into our client system. They call it the moat, and that are across different workflows. So agentic AI cannot work on multiple workflow with deep client AI. So there's still needs for trust. Who's going to verify whatever output it is, and who's going to, let's say, have that social proof towards clients. So the investment, I believe, is then in that crossroad where there's enough clienting modes with lots of deep workflows within clients, that are going to be served or wrapped around with AI. So you'll have some types of companies that are going to be end-to-end, IP plus people, and they are going to provide that service. And there won't be any problem, I'd say, of talking about professional fees. Because in the end, the output is going to be, okay, for X, you're going to have the IP, the tech, and whatever AI doesn't mean. And you'll have some consulting people on top. So, yeah, my take on that.
So, yeah, and can we just, and yeah, I mean, sure, of course, comment that, but also I'm interested specifically from UK perspective or UK's advantage or initial sales point for BBS sector. How do we attract global funding? What's our sales pitch for the sector in a way?
Sure, I was going to just add, I think it'd be a big discussion on outcomes-based pricing. I don't know what the answer is there, but it's an interesting point you made. So for the UK, professional business services, financial services, legal services, I don't need to tell the room, we are held in such high regard around the world as leaders in the field. So that in itself attracts venture funding into this sector. I think perhaps this is what, Shruti, you were touching on, maybe contrary to Xavier, your point, but I guess it depends on the context, is a latest stat I read is 70% of professional business services firms in the UK are adopting, piloting AI tools. And I think we are known for that. We're not seen as being behind at all. We're leaders in that regard. So again, it attracts venture funding. Global legal services revenues, 40% of those global revenues are attributed to a UK-linked firm. So I don't think we are lacking in our credentials when it comes to this sector, and it's standing out on the world stage from a regulatory point of view, from a language point of view, from a time zone point of view. We also supported by a thriving venture capital ecosystem. I think we're top 3 around the world, behind only the US and China. In Europe, we are the leading venture capital country for the UK, receiving more venture funding than, I don't know, the metrics they always throw in a few other countries, but France, Germany, Spain combined, is it Netherlands, is it Switzerland as well in there, who knows, but we lead. So we're coming from a really, really good base. We're also supported by the fact that for the first time, financial services and professional business services are recognised as a priority sector in this government's UK modern industrial strategy. So we've got the government recognition and support there in various forms. So there are sector teams within government that are there to support you. So please be in touch with me. I can put you in touch with them to give you support in different ways. There was one more point that just came into my mind there, and I've lost it. Maybe if we go to some of the other panellists and then come to me and I'll interject. But yeah, what do you think about the UK on the world stage?
Can I add a couple of not insignificant points, which are what we have got on our side is a respect for the rule of law. And so that is not to be, I don't think, sort of undervalued. It really matters that this is a jurisdiction in which we respect the rule of law, in which you can expect that if you go to the highest courts in the land, you will get a fair hearing from people who have diverse perspectives and who are sensible, not casting any aspersions, of course, anywhere else. But it says, I think the reason it matters is because it gives people legal stability and some sort of sense of, if something happens in this jurisdiction, what can I sensibly expect to be an outcome? And there is a level of stability in that prediction that you are able to make that you might not be able to make elsewhere. So sort of that's the first thing that I think we do actually really have going for us. But the second is that we're prepared to do those things while sensibly innovating. And I say sensibly innovating. So, I don't know, recently the digital assets, it's the world's worst name of an act ever. I think it's called like the Digital Assets, etc. Brackets Act.
Property, etc.
Yeah, we actually hosted a reception in Fuse to celebrate it, and I was like, why? If we were in America, we'd be calling this like "Let's Make Britain Great Again" Act. Like, why are we calling it the in brackets etc. Act? This is dreadful marketing. But actually, it's not insignificant that we're prepared to take a step forward to try and move things forward, to recognise a growth area of digital assets, and to try and set a legal landscape that sensibly allows for its growth. That is the way in which jurisdictions should actually operate, and that is the way in which we are operating, which I do think gives us a good foundation for growth. So I know it's a bit boring, but we are a safe pair of hands.
No, and we see that given geopolitical events. Also, I did remember IP that we have, which other nations, even if they've grown very rapidly, they don't necessarily have that. Our financial services sector, it might feel sometimes distinct from the rest of PBS, but it actually just means, and I see this, that we've got enterprise-ready, large companies that have already adopted and transformed through tech via fintech, and they are ready to do the same in professional business services. And so being able to show that as a use case, a proof of concept with a huge customer base here, ready for you, allows us to present to investors from around the world that you're not just investing in a UK company, you're investing in something that is an exportable model around the world.
Okay, I mean, this is all good. One of the reasons why UKI Innovate UK and kind of supports R&D and invests is that markets don't fully and well support the sectors, and the sector's not well served by markets in terms of investment. And in our conversations, we identified a number of barriers and challenges. So can we dig into these a little bit? And even speaking about IP, kind of the service sectors, at least the conversations we had with a number of firms, is that exactly the fact that you don't have a hard IP, it makes it challenging for attracting investment. So can we identify what are the structural kind of challenges that we need to address?
I have a simple answer to that one. You said the UK is number 3 in startup. Correct. It's number 13 in scale-ups. The problem is money, right? That's a simple problem. There is a very wide, diverse ecosystem of venture capitalists. There is no very large Andreessen Horowitz size venture capitalist. That is a major problem when companies want to get to that next stage. So that's a very simple answer to you. There is a very simple structural problem here, which I know is trying to be addressed with the Mansion House Accords, etc. But now the FT political editor tells me it's dead because it's just too hard. So that is a simple question, and I'll leave it there. A simple answer, rather.
Well, so yeah. So do you know, I also come from France, and when I hear that you're very far, from scale-ups, from the US, it's how far and far we are. So, so it tells us that we are even further. But yes, to answer very quickly the question. So it's about de-risking and de-hedging the relationship, so the pilot phase, so between the integration, so between the startups and enterprises. So as a record, as a reminder, so we served 2,500 large companies, large enterprises and public sectors. And so we know that, yes, there's a lack of bridge there, on piloting, whether there's any funds that could actually support the tripartite piloting between the large enterprises and our types of companies. Yeah.
I mean, Xavier, you're not joining my marketing team, that's for sure. What kind of cheerleader are you? I mean, I actually, sadly, have to say I do agree with you. And the problem is made worse by the fact that, so I was going to pick up on something you said about Claude earlier, but legal tech, it kind of doesn't really matter. There is no, I don't need a UK legal tech company to service UK law. Law in that sense, and the use of AI in that sense, is it's global. So I can have any provider based anywhere in the world, and I just need it to be the best. And often at the moment, the best equals to the most well-funded. And to the point you were making earlier about, well, what will happen now when we've seen Anthropic entering legal? What will happen to the Harveys and the Lagoras? The only actual moat in that sense isn't the jurisdiction, it's the intractability of lawyers and our inability to change our processes quickly. And actually, weirdly, that's it's a temporary moat. It's not a permanent moat, but it is nonetheless going to be interesting to see how quickly the Harveys and the Lagoras can become sort of sticky and move fast enough if they can sort of overcome that and make it more of a permanent moat. But that, I think the jurisdiction problem is that I don't need a UK-based legal tech to do my work. I just need something somewhere that works well, and it doesn't really matter who it's funded by or where it came from or where it's based. Or even, we're seeing more and more that language is less of a problem, whereas before, actually the language differentiator used to be quite large. That's falling away actually quite quickly.
And Katie, you mentioned on our call that you see some investors wait and see what will happen in this space. I mean, do you want to delve into that?
I think to Sochit's point in terms of valuations, seeing where they land, I mean, that's not unusual for the entire sector. Like for all multi-sectors, not just PBS. I just don't think funding into PBS gets a huge amount of attention, but that in itself can present an opportunity of if you do have proof of concept, you do have the client base already, then that makes you an incredibly fundable opportunity. But also, I'm conscious that the room might not be looking for venture funding. We might have different types of companies, sizes of companies here, so there might be other things that are of value to them in terms of support they can access through government, AI piloting initiatives, AI adoption, funding. So again, if that is more relevant to you, please get in touch with me on LinkedIn. I'm happy to share my email and we can share those opportunities with you. That way, put you in touch with the right people across Whitehall.
Yes, go ahead.
I'm going to rejoin the cheerleading team. There is one thing that the UK, and slightly in answer to your question, has, and it's not the professional businesses that we think of normally, but it has the NHS. It has the largest pool of clients. The database are not well unified, etc. But it is and the GPs are disparate, etc. But it is a very attractive market, and we're seeing some very, very interesting companies within that vertical, which is highly protected against AI because nobody wants their client data flooded to an AI. There are some very interesting businesses that are professional business services because they are serving doctors, they are serving the NHS, etc. That is a very interesting area of focus, and I think that's an area that's been massively underdeveloped at this point, but it's starting. So on that front, that is a very exciting opportunity in the UK.
I mean, that's really interesting. And can we actually expand this a little bit further into understanding basically how can we better we with Innovate UK, UKI, and other aspects of the ecosystem can support investment in PBS. I mean, even Shruti, when you think about some of the success of your startups, you don't just give them some financial support, but for example, you give them access to clients and data. So can we, because the next panel will be looking on mobilizing capital, and it will be a good way for us to try to finish, as we talked about, on a more positive note and optimistic, and to have a strong cheerleader panel here. So let's try to pull some positive.
I can be a cheerleader. I mean, the one thing I'll say is very special about the UK and legal tech is that, so I've been doing this 10 years, and it really started as a grassroots movement. So we did actually start 10 years ago with a bunch of very small startups who have actually done very well on the world stage, so not just within the UK, and they're growing really particularly in the US now. But it means that we have an ecosystem which is very, very special, and which is made up of people who have grown up together, supported each other. Actually over the course of 10 years, we've built something very solid and a very solid foundation of companies who are all doing very, very well, who are sort of sharing knowledge with one another, and who have started to actually see that they are able to deliver returns in a way that I don't think they would have expected when we first started. Because when we first started, it was like a sort of a cottage industry, if you like, and it really has grown enormously. So I wouldn't ever discount the importance of being part of a successful ecosystem and what that means for the companies in it. And I don't think, if you look at the US, that's one thing they don't have. It's huge, it's fragmented. None of them know each other. They don't operate together. They don't plug into each other in the same way. State by state, it's not, you don't have the same benefits of being part of something where you are all working together and understand each other. And I do think that is very special.
Yep. So I can be the second cheerleader as well, and I really do believe so. UK is special. So UK is special in its sense that so financial services, of course, legal systems and framework, and the innovation ecosystem is the strongest in Europe. It just is, and it's just also within the top 3, top 4 of this world. So and that's not a nascent ecosystem. It comes down to the 2010s, right? So 15, 20 years, I'd say. And this 15 of 20 years, that's where you had lots of verticals, lots of depth of solutions within either financial services or whether legal or professional services that are here now combined on a land that can actually potentially go with other services. And what I mean by that is that there's so many companies, innovative companies, that could actually work now with professional services in order to become, by 2030, if that's the case, the country which would combine IP and professional services together. So you've got the ground for that, and that's a real belief on that.
Yeah, I like all of that. I think our tech ecosystem is valued at 1.2 trillion. We've got over 200 unicorns. We're in the 200 unicorn club, which is alongside just us, the US and China. But I'm not here to persuade you of why everything's so great at that high level. I think it's right the way through, as Shruti or Sochi said, and who knows what, hopefully Xavier as well. But our ecosystem is incredibly strong. If you are in the PBS sector, if you have got those enterprise clients perhaps already, then that is really something to shout about. Make sure you do shout about it. We can help amplify what you're achieving too and get it in front of hopefully investors that could really transform what you're doing. And in terms of unlocking capital in that scaling proposition, I mean, crikey, it's acknowledged, and the measures that have been put in place. I think this government, and I'm a civil servant, so I'm not political, I'm neutral, but in terms of what they have focused on is unlocking that pension capital, deploying through the BBV, ensuring that there's a pipeline of capital opportunity. But I think last week in the House of Lords something was voted down, so there's challenges there. But from a Whitehall perspective, there are a number of teams that are working on scale-up support. So if that's something that would benefit you, please be in touch. Like I said, it's acknowledged that whatever can be done there would be beneficial. And that goes right the way through to startup, all the way through to listings and the London Stock Exchange. And it might sound ambitious, but if you were saying that in the US, no one would be laughing. If you were saying that in the Gulf a few months ago, no one would be laughing. So I think it's also for us to, even if we're naturally sometimes cynical, is just to remember that there is a lot that we can leverage, and just do it. Use Whitehall for your advantage and come to me to help us do that.
Unsaid in all of this, because it's such a daily part of my work, is the UK universities, right?
Yes.
We work with nothing but, we work with nothing but high-tech startups, and an enormous number of them come out of UK universities, right? The UK is basically number one in the world on quantum computing. Unfortunately, as we saw with Oxford Ionics, they sell themselves to the US because of lack of funding, but we see just daily enormous amount of IP being spun out from the UK universities, and that is definitely a massive competitive edge.
Brilliant, thanks. I think that's a really perfect setup for the next panel, mobilizing growth and investment. So please, before we do that, can you please join me in thanking this fabulous, amazing panel?
Thank you.
Thank you. Yes, so our next panel is on mobilizing capital for UK growth. May I ask all panelists to join the stage? Thank you.
Good morning. As people are coming up, just to reflect on the panel just now, I don't think Mansion House is dead, just to be clear. But I do recognise that it's hard, and particularly where you're trying to get long-term investment vehicles aligning with venture returns, fees, timing, and so on. But I was just reflecting that sense of reputation for professional business services in the UK and from the UK. I was out in Hong Kong with Jason Stockwood, the investment minister, in December. Everyone wanted to talk about bringing professional business services, legal services, everything else to Hong Kong as a trusted source. And it was a UK that was really representing that. So honestly, I think this is a sector that UK has a good deal to be proud about, and actually there's a massive opportunity to innovate in this space as well. So I'm going to join my panel because they've got up here even faster than I thought, and I'll let Ian defend what you're doing around Mansion House and stuff in much more detail than me. Maybe we'll just take a chance to introduce ourselves. So my name's Scott O'Brien, I'm Chief Investment Officer at Innovate UK. You'll have heard some stuff from Astrid already around the strategy and that, but we'll come back to that as we go through. But Ian, why don't you kick us off?
Hi, morning everyone. My name's Ian Connerty. I'm the managing partner of British Growth Partnership at British Business Bank, which is one of the initiatives that we're setting up actually in response to this whole mobilising institutional capital at scale. So very happy to talk about that in more detail as we go.
That's great. Thank you. Should we just pass it along the line?
Hi, I'm Dave Foreman. I'm CEO of PXN Group. We're a venture capital and alternative investment business based in Manchester and Edinburgh. So we focus on investing in the north of the UK.
Good morning. I'm Beth Ann Cousins, new business director at Development Bank of Wales. Our mission is to unlock the potential in the Welsh economy. We're providing sustainable funding and co-investing and really crowding in investment into Wales and other English regions as well on behalf of BBB.
Thanks, Beth. And Ant?
Yep. Hi, so Ant Barker. I look after venture capital at Aviva. I wear sort of two hats, really. So first of all, I look after our corporate venture capital strategy, and secondly, our venture and growth capital strategy, which is on the client money side.
Okay, thank you. So hopefully you'll see we've got a range of speakers here from that early stage all the way through growth pivots and into adoption, diffusion and scale up as well. So maybe it makes sense to follow that journey as we go through. And maybe I'll throw to Bethan first of all. Think about that sort of early stage investment, seed, pre-seed, angel, however you want to frame that, through to Series A and your models for adopting that.
Yeah, absolutely. I mean, it's something we've been investing in Wales for over 20 years. And, you know, we're trying to develop that venture capital ecosystem, actually, and very much looking at those early stage pre-seed is an area that's quite challenging, I think, to find funding in. So we've developed a dedicated angel network, and we often sort of co-invest alongside the angels. So it's really sort of developing those partnerships, I think, because I think that's really important in that early stage and Series A to come in as a group. And I think that's what we can do as Development Bank of Wales, is to act as a bit of a catalyst, provide a bit of local intelligence. I think that's really important as well in terms of market intelligence, and get that syndication together to provide funding.
Okay, and we've talked, we've heard a little bit earlier about sort of different types of opportunity in this space around innovations, be it legal, various other bits and pieces, fintech, accounting. Are you seeing particular trends coming through in that early stage from your point of view?
I think we've got a few sort of strong clusters in Wales. So, you know, advanced manufacturing, we've got creative industries clusters and sort of fintech as well. So I think those are, you know, still sort of operating quite strongly. But I think all businesses at the moment are sort of trying to grapple with this AI, you know, how they sort of embrace that tech enabling and how they build that into their businesses to do that transformation that we were just talking about on the panel earlier.
Okay, thank you. And Ian, I'm conscious that BBB has just announced additional funding into the regional angel networks and creation of new angel networks. I know from the Innovate UK side we have several within our investor partnerships, but I don't know if you want to say more about what the bank is specifically doing around angels.
So angel funding is super important. It's important everywhere across the country, but it's particularly important outside of London, where, as you say, actually getting deals to nucleate and creating kind of critical mass in funding rounds is super important. So we have, for a while, been running something called the Regional Angels Programme, which partners with regional angel networks up and down the country, and what that gives you actually is access to the rich flora and fauna, if you like, of all the business types across the UK. And just in respect of this sector in particular, what you find is broadly two types of business that get supported across the country. One is the kind of technology, venture-backed, kind of right at the leading edge innovators. And the other one, as you kind of alluded to, Scott, is actually more the adopters who are accounting firms, consulting firms, all that kind of stuff, who are fast growing, but they're actually using the technology that's being adopted by other people. And again, outside of London, that's a theme not just in professional business services, but kind of more generally. And someone on the previous point made the point that venture is one type of funding, but again, outside of London, what you find are a much broader range of financing that are really important to growing businesses. By the way, including bootstrapping and not raising any money at all, right? That people forget that is a kind of option. But debt finance is super important, and there's kind of all kinds of other flavors of finance which yeah, we're tackling the kind of venture end with regional angels, but the stuff that we're doing that's much broader than just that.
Yeah, thank you. David, I don't know whether there's anything you want to pick up, because obviously PXN play in this space to some degree and have for a number of years.
Yeah, I think if you look at it from a PBS perspective, there are two things that are interesting at the moment, which is one, speed of adoption of the changes, and I think PBS as a sector, quite rightly, and the UK sort of historically has always been played on the trust and the safety of the service we provide. I think it's a really interesting time now in PBS because there is an element where people who can take a little bit more risk, obviously within the right reasons and making sure data and all of that good stuff is secure, those people who can take risk might have an opportunity to grow faster than the incumbents. And then looking at it regionally, the point has been made many times that there isn't enough funding in the UK. That is especially true in the regions across seed through to scale up. And that is something that, you know, people like our firm and others, the British Business Bank, the pension funds, are all trying to address, to give those people who don't live in London and don't work in London the opportunity to grow their businesses just as quickly as other firms. But I think what we've got to understand when you think about that problem in the regions is the end customer doesn't care where you are. So the purpose of sort of investing in the regions to help the entire UK get better and compete better nationally and globally. But the end customer, the user of a service, doesn't care whether you're based in Manchester, doesn't care whether you're based in London, doesn't care whether you're based in France, because they just want the best service at the best price. So it's not a moral thing for people to have to invest in the regions, but the regions has to level themselves up so they can compete nationally and can compete globally. And the UK has to level up so it can compete with America. We don't have as big an economy, we don't have as many people. You know, the whole world has got a lot smaller following COVID, following AI, following sort of, you know, faster broadband, etc. And everyone just has to get better very, very quickly. And that's an opportunity in PBS, it's an opportunity in the regions, it's an opportunity in the UK. But nobody's going to pick you because you happen to be based somewhere or you're in a country. That era has gone.
Yeah, that's really interesting. I mean, one of the things that Innovate UK is trying to do through its new strategy is to look at the idea of de-risking, and where its additionality comes from its ability not only to provide capital where capital wouldn't otherwise be, so the level of risk that we might take, but also to provide that and enable pace. Because actually pace is as important in getting to market as some of the other challenges, I think, being ahead of the competition and establishing your reputation in that space. And that's where Innovate UK is saying, through the team that's here, we have expertise and we understand that, and we will go in first and de-risk that because that enables others to follow in. I wonder if there's also something about, is maybe bigger checks elsewhere, capital efficiency here, valuation and prices could make this attractive because of that differential and the fact that we are used to either bootstrapping or living off relatively small capital raises and being super efficient in terms of how we use capital within that. And I don't know if you've got a view on this part of the market, but feel free.
Yeah, absolutely. So, I mean, I think fundamentally we know UK companies raise less money at every stage than their US counterparts, and in particular at the growth stages. We are particularly underweight in the number of scale-up funds that we have, the amount of capital that goes in. We know that where companies in the UK do raise capital at those stages, 80% of that tends to be foreign investment or foreign-led. And so, you know, the work that the BBB are doing, the work that Mansion House is aiming to accelerate helps that. Maybe with my sort of Aviva hat on, how we think about accelerating and being an enterprise customer as well as a sort of CVC and an investor. I think a big part of our strategy is how do we not just invest, but how do we co-create, how do we collaborate, how do we partner with early stage businesses to accelerate our own strategy, to get ahead of some of those curves that might come and be disruptive to our traditional business models. And then we have a CVC arm that enables us to also place some bets and make some investments in companies at the same time. Now, we don't make investments contingent on partnership, because we would never get anything done if we tried to tie them together explicitly. But that dual strategy, I think, where that's where larger corporates within the UK can play an important role, helping some of those earlier stage companies really get to enterprise ready to be able to kind of scale that out and provide some investment in the background as well.
Yeah, that's really interesting. Thank you. One of the programs that I run at Innovate UK is innovation loans. Ideally for the later stage innovation going into commercialization, and what we tend to look for, adequacy of capital, because quite a lot of businesses through the years have had grant funding, more grant funding, come to me for debt, and I say, where's the equity, where's the capital that sits behind that? And they say, we haven't done that yet because we had grants. Okay, so you've got £1 million hold in your balance sheet and you want 5 million of debt. That's really challenging. However, what we do see is people with a plan to raise, with a team that's established, with a real technological advantage. And where there's that commercial traction, that's the bit that flips them in. And if they've already got those partnerships built, they've already got the pilots underway, that really helps. I wonder if we move into that sort of growth inflection point and how you see companies bridging that and maybe where the capital might come from for that. I guess probably Series A into B, that inflection point from revenue generation into early profitability. I wonder what you see in the market. Anyone who wants to come in? Yeah, go on, Bethan.
Oh, no, I was going to say, actually, that's a really interesting sort of tipping point, isn't it? Because the earlier stage investment is often there because it's pre-proof of concept, but that scale-up gap is quite challenging. I think we're seeing a lot of venture debt coming in now, actually, to sort of bridge that alongside investment. So I think, it's certainly one of the challenges, I think, with raising that funding at that stage is you often find a skills gap in the teams. So one of the things we need to get confidence in when we're deploying capital is the team fully formed? Do they have enough of a track record yet? Have they got sticky customers? And can they evidence that sort of contractual visibility on revenue? So those are the sort of building blocks, really, to give confidence to investors to go in to unlock that scale-up.
Thank you. Dave?
I think it's a really interesting point around sort of, you mentioned there about scale-up and sort of the flip to being profitable. And I think that comes down to sort of the UK's attitude to risk. There are plenty of businesses, once you get past 3, 4, 5 million, if you're talking about a SaaS business, you can get profitable because you can run the business for less than the cost of the revenue you have coming in. That's not necessarily the strategy for growing very quickly, and that's not necessarily a scale-up thing. So you are talking about sort of slightly cross-purposing. I think that's because the fundamental ecosystem in the UK is pretty, as I said before, pretty risk-averse. The best companies in the US, let's just use the US as a good example, when they get to 3, 4, 5 million of revenue, they don't talk about getting profitable. They talk about how can we get to 10, how can we get to 20, how can we get to 30, how can we get to 50. And they have much more ambition. And they have the funders to do it. They certainly don't think about taking debt on the balance sheet because they're not in a position to be able to repay loans. When you start taking debt, you start looking at your cost base, you start making sure that you can repay the debt. Often they get rearranged, and that's totally fine. But I think the venture debt world in the UK generally is coming in too early, and you need more equity risk, taking on more risk to help these businesses grow. We talk about why there isn't scale-up. The reason there isn't a huge scale-up thing is because it hasn't been proven as a model. Venture capital is a relatively early-stage economy in the UK. I would say, venture firms have really been operating in the UK for 10, 15, 20 years. Compare that to America, they've been going 50 years. They've got the A16Zs that have proven they can back Facebook and Twitter and all of the names that we'll all know. And therefore, they've got incredibly large and can take incredibly large bets on things because they've got the proven track record. In the UK, we're an early and more nascent economy, and therefore we're still in that figuring it out phase of how do we help companies get from 10 million ARR. 10 million ARR in venture in the UK is like, we're doing quite well. 10 million ARR in America is, it's still a bit subscale. It's just a very, very different mindset. And the entire ecosystem, the supportive people like Aviva, like the British Business Bank, the venture capitalists, the Development Bank of Wales, everyone in the ecosystem the founders themselves, the buyers of the founder services, they all have a part to play in helping these businesses go from being pretty good UK companies with 200 unicorns to being great global companies that compete with the very, very best firms in the world. And I think, just to pick up something that was said in the previous panel, there's always the reductionist view, which is that Anthropic is going to take every single sector, it's going to be in legal services, it's going to kill Harvey, it's going to kill all these things. That never happens. It has never happened in the past. It doesn't always just go to the underlying base technology. Otherwise, Google and Amazon would be the only e-commerce players available around in the world, right? That just isn't what happens. Everyone has the whole thing comes down to about how do firms grow and how do they capture value that can be created. AI is a great change agent in that the way you capture value will change. The way you sort of finance your firm will change. The amount of people you need in your firm might change. These are all great opportunities that the very best companies and the very best founders and the very best leaders will massively capitalize on, and therefore will grow significantly. And I think the whole thing I see from the UK, regionally UK institutions, is we've got a very big culture of you never get fired for picking IBM, right? People don't want to make the difficult choices, but we're in a world now where things are changing so rapidly that people who run PBS firms, people who buy services from venture capital-backed businesses, people who run venture capital-backed firms, we have to embrace more risk, because by embracing more risk, yes, you will have more failures, but you'll also have much greater outlier successes, and that's the key part of venture. It is not about managing the downside risk, it's about maximising the upside opportunity. And that, I think, is every business in the UK right now.
Thanks, Dave. Ian, I'll bring you in.
Yeah, so your question was about the kind of A to B transition, and kind of to the point, that's the first of a number of transitions you need to make if you then want to go on and be a global business of scale. And again, just to kind of make this a bit more digestible, a kind of typical Series B, let's pick a number, let's say it's a 50 million-ish type of round, or 20 to 50 million type of round. So you probably need to have a fund of about 150 to 200 million to write the lead check in that kind of round. We have more of those funds now than we've ever had, than we had before, right? So that's great. When nearly 20 years ago, I just started work for a startup, and that kind of ladder, those rungs on the ladder weren't there. The kind of early stage bit, this kind of A to B transition, it's the bit after. As you grow and scale, the problem becomes more and more expensive in terms of the rounds that you need, the size of the rounds, and therefore the size of the funds that you need to be able to write the lead check. So that's the bit where the kind of the efficiency of the ecosystem from creating startups to creating unicorns starts to break down. And again, just to put some numbers on that, in the UK, for every 1,000 venture-backed companies we have, about 6 of those go on to be unicorns. In the US, it's 19. So that's the relative difference in the efficiency of the two ecosystems. Where companies get the money that they need, that gap doesn't completely narrow, but it's much healthier. So it's kind of, in summary of what you said, I would say is the availability of capital genuinely affects ambition levels. So there's kind of two sides to that. One is, again, having been on the other side of it, there's a business plan for if you can raise the money you want, there's a business plan for if you can raise some of it, and there's a business plan for if you can raise none of it, right? That's just how life goes. So there's something about the availability of capital that affects the outcome. It's not, and that's important to say. The second thing that's important to say, though, is if we want to earn our keep as venture capitalists, we have to be able to tell the difference between businesses that genuinely have the potential to go on and be enormous outliers and businesses that don't, and that's the kind of skill of the craft. And again, the reason I say that, and it might sound obvious, is not every single business has that potential, and therefore the kind of venture that we're talking about isn't necessarily the right kind of capital for that business. And invariably, actually, it's when you're making that transition into scale up that's becoming more obvious. And again, I was in a meeting this morning. We were talking about the kind of graduation rates from different rounds, and it's really important to remember in venture that is not 100% at all. Even as you graduate through the rounds.
Yeah, it's really interesting. On the programs that I run, we see two versions of the forecasts. We see a version which is written for us because they think we're a debt provider and therefore they give us a nice cautious thing. And then you see the ones which are essentially just a hockey stick and built on fresh air. And actually what I want to see is a realistic growth plan. Because if you give me the one that's like that, well, I'm not going to do it because there's no economic impact or benefit to the UK coming from that. So go away and think again. If that's genuinely what you think, I'm not interested. Equally, if it's a wild hockey stick, the question, go and show me how you get there. Show me your funding strategy. Show me how that system works. Just reflecting on one thing you said there, Ian, about the size of the fund necessary. I mean, this comes back to the Mansion House question, I think, because if you build a 100 million fund and that works and you make returns off of that and you start to scale your operation, what it allows you to do is drop some of that fee because you know you're going to make funds at the back end and you've got sufficient liquidity in your system to run it on the basis of a lower fee, which allows the Mansion House signatories to come in and say, that looks a bit more like an asset allocation fee in terms of that's an affordable level I can go in, I can convince that compared to investing in blue chip stocks on the market, that looks broadly similar and there's potential upside, so I can sell that. When you're going in as a fund manager and saying, okay, well, it's 2.5%, 3%, that becomes challenging for pension funds, I guess. And I don't know if you've got a view on scaling funds that allow that scale to happen in and from the UK.
Yeah, so, I mean, absolutely fees have been front and centre of the conversation we've been having. I think there are a few things that have, and I would completely agree, I don't think Mansion House is dead. In fact, we know it's not dead, but it is taking much longer. I think everyone expected it would be more back-end loaded in terms of getting to deployment, and there have been a number of hurdles to kind of get through. One has been fees, and so kind of institutional creators of VC funds that can allocate capital to existing fund managers, but also deploy capital directly and take a blended approach to enable to kind of reduce that fee burden, is starting to kind of get some traction. That does come with additional challenges, though, of, well, track record. So if you're a trustee of a DC pension scheme looking at where your strategic asset allocation, you kind of want the best of both. You want something that's new and low fee burden, but has a long track record, and those things don't quite exist yet, but we're getting there. And some of the enablers of that, so, and I know Aviva's not alone in this, but we've launched Venture Growth LTAF. So it's long-term patient capital that's able to invest, patiently in UK businesses, but also with a fee structure that works for DC pension schemes and doing a sort of blend of direct and indirect to create a diversified approach and reduce some of the risk. And we're not alone in that approach, but it is taking time for that to, so we launched January 2025. We've now got a year's worth of track record that's starting to build. We've got a first allocation of capital, so pension scheme capital, client money. So we're at sort of 280 million. Ambition to continue to kind of scale that, but it's not an overnight fix.
And just out of interest, where you say long-term and patient, what's your return window? What do you mean by that? So just give a flavour of it in the room.
Yeah, so the fund structure is evergreen. So it's not closed-ended. We don't have a 10-year sort of typical 5-year deploy, 5-year harvest. Some assets we will invest in, looking for a faster turnaround and an earlier window. But if you think about particularly some of those that require a longer time to technical de-risking, et cetera, then there's the opportunity to kind of blend that in and have a 7, 8, 10-year window before you're fully exiting and looking to get DPI.
Okay, thank you. I don't know, Ian, it was worth coming in on the regulated bit of BBB and how you're viewing that part of the market off the back of that.
And there's a kind of few themes here. One is that to the kind of point that you made, Scott. It's about finding the right mechanisms for this kind of capital to work its way into the system. And if we can do that, by the way, the win-win-win here is that creates the structures for the bigger funds. that actually creates optionality then for the GPs, as you say, to kind of not just grow assets but create new products, and ultimately then ends up in the kind of companies that we all want. So we think there's a mechanism here or a way to do this that works for everyone. The kind of analogy I use is a bit like, if you know those coin machines on the seaside, where you put your 2p's with the kids and you put the kind of coins in. So even from the moment where you've decided to put your 2p in the top of the machine, so you've made your allocation decision, you need to be really comfortable that the mechanism in the machine actually is going to make sure that the coin is going to land in the right place and then moves from shelf, with GPs, then ultimately to the next shelf to the companies. And making sure that coin can wend its way down to where you need it is basically the thing that's taking the time. But because that's all behind the scenes and kind of hidden and actually really quite difficult as well. I'll be honest, as someone who is engaged in that literally, not quite as we speak, but right at the moment, it will take time. But I think it will feel slow and then very sudden. Is my sense. I think there will be because if I think personally about some of the nature of the challenges that we're trying to solve now, things like venture capital ordinarily values on a quarterly basis. How do you reconcile that with all the kind of structural issues around DC pension funds and so on? Well, actually, once that's solved, then there's a market practice. It becomes much easier for everybody. So part of it is the kind of pathfinder nature of what's going on. So based on what I see, look, there's plenty of people working super hard, really hard to try and make this happen. But what it does, to come back to one of your earlier questions, is that's then what unlocks the scale of capital, that unlocks bigger funds, that then, to your earlier point, that's then actually we don't move from A to B graduation, we move from B to C to D and down the chain.
Thanks, Ian. And Bethan?
No, I was just going to say, actually, in terms of unlocking scale of funds, which is really important, I think, isn't it, to have the confidence to invest, to drive some of these large businesses. We've just, the Welsh Pension Partnership has sort of been introduced in Wales, which we see as a really positive move. We've actively been working with pension funds ourselves for the last sort of 6 or 7 years. It's really about kind of getting under the skin, really, of, what are their specific briefs. So, the pension fund we've been working with has been quite targeted. It's about succession funding. I know that's more sort of stable asset base, but actually if you can develop that track record and target that. We also manage a £500 million fund, which is a blended fund, actually. So it does have seed capital within it and Series A, but we're also counterbalancing that with later stage debt investment as well. So that kind of blend of return as well, is quite attractive, I think, to crowd in other funders, because they can then mitigate some of the earlier stage risk with, more stable returns, which, can work quite well, I think.
Yeah, so really interesting. I was on a panel hosted, I think, by Antler, but with the Strategic Pension Fund for Ireland and the pivot they made around the banking crisis, where they turned that into the Strategic Investment Fund. And the pitch being made there was actually, if you invest in frontier technologies in that space, then what you get the benefit of is actually they're relatively counter-cyclical. They move into new value propositions, into new spaces, because the other market is falling away, and actually you're slightly more resilient as a result of taking that technology risk up front. But interesting to see if that model proves out.
So just one final point on why this potentially unlocks so much. So to your earlier point, in the US, which we, I think, probably compare ourselves sometimes to a bit too much, but just to take that comparison again, in the US, where they do have these large platforms, about 70% of the LP capital for venture funds comes from retirement savings of one form or another. And in the UK, that equivalent figure is about 10%. So bridging that gap, we think, is the kind of opportunity that is genuinely meaningful pension fund participation in venture.
Okay, so maybe we just, in the last 5 minutes, round it back to professional business services and think about appetite for that. So we see it's one of the 8 within the industrial strategy. We see that there is a clear opportunity in the UK. In terms of your own target, your investment thesis, how this plays into it, it'd be really interesting to hear how this market appeals.
I think we've always been interested in this market, actually, because we've always been targeted at funding a gap where perhaps conventional funding with, who likes asset-backed investments, they haven't really invested there. So we've always had an interest in professional business services. And, for us, it's about the right team, the right articulation of a plan, some defensible IP, or just a USP, actually, which which places them, in a strong position. Those are the kind of characteristics I think that would attract us. But absolutely, we're keen to back businesses in this space.
Yeah, I mean, I'll come back to maybe what I said at the start around corporate venturing. So, I mean, we're a natural customer of PBS companies, and so we are keen to work with, partner, pilot, co-create, as well as invest in some of those early stage companies. I think some of the, and I don't want to kind of repeat what was talked about on the first panel, but there's some genuinely really valid and interesting points there, particularly around AI and how that will reshape some of those businesses, and in particular where companies can take real advantage of that and actually scale in a way that is much more margin accretive, then I think there's huge venture potential within that.
Okay, and I wonder, is there something there around valuation point and expectations in those markets in the UK? What are you seeing there? Do you think people come in with realistic ideas of that, or how to pitch that? Maybe Dave, that's your
founders come in with completely unrealistic expectations.
I sort of assume that might be the case.
Surely, but that's their job, right? They're supposed to come in with for us when we're investing, whether it's PBS or any other sector, the whole thing for us is about whether we can think that business, that founder, that team can generate outsized returns to which compensate for the fact that we are taking a lot of risk and that some of the businesses we back will fail. So for those who are maybe thinking about raising capital in this sector, I think it's all about having a plan that says we are on an aggressive growth plan. We are thinking about making outlier returns. We don't want to just grow 5% per year by taking on another consultant and we can charge their time out at X pounds per hour, right? That's not a venture backable model. That's not an unfundable model. It's just not a venture backable model. I think the interesting space in PBS is partly also around sort of how you frame PBS. Is it just consultants who are providing services, or is it those technology businesses that happen to be doing B2B software that is also professional business services, just under a different title currently? And I think those firms who are now, I've said it a lot of time and I'm probably in danger of repeating myself, but those firms who are prepared to embrace risk, take a risk about how they grow their firm, how they grow the business, how they create outlier returns, they're always going to be interesting to people, whether it's a change in the business model, whether it's about how you capture value from changes in technology, whether it's about how you can look at your pricing or your service model to make it different from the incumbents. The incumbents have always and always will be slower to embrace technology than the early stage, founder-led businesses, because they can take more risk, and therefore that will continue. AI is one technology; it's pretty seismic, but it's just one technology that's happened, and people can use that opportunity to go and build a great business and grow very quickly, and that will always be interesting to VCs or early stage investors or people who are investing in innovation. I think it's all about people just understanding what the funding market is looking for, understanding who you're talking to, and present your case in a way that makes sense for those people who are looking to invest. I was going to say something nice to end, but then I've run out of things to say, so apologies.
Okay, we won't need to say anything nice about it. We'll do it afterwards. Ian, do you want to round us off?
Just on this topic, I mean, I think it's such services generally are such a big part of the UK economy. We have therefore, but as a result of that, loads of the ingredients you need for innovation to thrive here. It's all been mentioned before, all the way from the universities, all the way from university all the way through to end customer, right? So, and what we're working on is the kind of capital that kind of wraps around it.
Okay, thank you. So I guess in that context, what Innovate UK is trying to provide is the due diligence engine around that helps to de-risk the early stages of that technology innovation and then present it to the market in a way which looks investable and sensible and de-risked, where we look at the team, we look at the other things as well, we look at that traction, we look at those opportunities, because we want to get them to the point where somebody else picks them up and funds them, because we're here to generate that early catalysing effect in the market. We're not here to fund things the whole way, and that's where the partnership with BBB, where the exposure to the market really works.
Yeah.
Okay. I think that's probably us, because it's 11:30. So I'm looking at Astrid. Yeah, and we've landed on time. So thank you to my panel. Really good to have that conversation. Thank you.
So I have the opportunity to welcome this very nice panel today because we talk a lot about ingesting money in the ecosystem, in innovation and everything, but at some point we have to get this money out, or at least the LPs and the British Business Bank, they won't have money to invest in new companies. So the objective of this roundtable is really to discuss on how the market has been structured the last year about secondary transaction, and I have really the pleasure to animate this roundtable. So before starting, I suggest that you introduce yourself, and what would be interesting is also that you can share a word on how you work in this secondary market.
Happy to start then. Hi everyone, pleasure to be here today. My name is Roman Stokes. I'm half French, half English, based with a Paris-based tech investment platform. We've been investing in tech for something like 20 years. We started off investing as a fund of fund, investing into VC growth platforms both in Europe and in the US. We then expanded to investing directly into company at the growth stage. And we also have a public equity strategy. So naturally, a few years back came a missing link, which is secondaries. And that very much ties with where the venture capital asset class is right now today. There's something like 5 trillion in net asset value, which is still private today, and managing liquidity there is very much part of bringing the asset class forward, and that's where we're positioned today.
Hello everybody, my name's Mark James. I'm the founder of a firm called Investor Reach, which helps investors of all shapes and sizes meet and communicate with investors. I spent 25 plus years in investment banking. At any particular time I was an analyst, an investor around money, a broker, straddling both private and public markets. I was reflecting on this earlier. I also took time out to go and work for the main board of PwC. I'm a chartered accountant, set up an innovation function in 2012. So I know the challenges there around innovating and growing some of the professional services firms. But I'm here today because 2 years ago, set up Investor Reach. I'm a consultant to the LSE. I've been working with the LSE on a really exciting project, I think. This is the private securities market. It utilizes this new, you may or may not have heard of it, but legislation here in the UK. It's called PISES, Private Intermittent Securities Capital Exchange System. Someone somewhere is very happy with themselves about that acronym. So PISES is the legislation. Private securities market is the LSE's market, the first new market since AIM, and it's aimed at secondaries. It is company-led, enables companies to elect to have one-day auctions where the LSE will provide the infrastructure, bring together buyers and sellers. Shares change hands on that one-day auction. They settle under crest, so T+2, so very, very different to any private market transaction. Company goes back to being a private company again. So we can elaborate as we would go on, but it's, I was saying to Romain, my life has just got a lot more interesting because 18 months ago I was talking to people about the legislation which may or may not get posted. Today I'm speaking to investors about the companies that are coming down the LSE's private securities market pipeline. So for a Gobiac stockbroker to be able to talk about companies and introduce them to investors is a lot more interesting now.
Hi everyone. Is this working? Yeah, there you go. I am Will DeVille. I work for a company called Salika Investments. We manage about 850 million pounds of asset under management, and we invest that capital in sort of 3 core different ways. So that is venture capital, so early stage seed investing, so right sort of first initial checks, lead rounds, etc. Our other equity strategy is a direct secondary strategy, so we can get into what direct secondaries versus other forms of secondaries is a little bit later on in this panel. But that is sort of probably our most relevance to this panel is the direct secondaries piece. And then we actually have a debt fund as well, so lending directly to SME businesses all across the UK and some in Europe as well.
I'm Ayel Investments. I'm a managing partner at Launchpad Capital. We are a direct secondary specialist and a liquidity provider, so we use our funds, we use SPV vehicle, we use a proprietary data platform which we run on secondaries, running just under $500 million, mostly direct secondaries, a little bit of LP stakes.
Okay, excellent. Before starting the operational question, I think it would be interesting, Romain, if you can explain how the secondary market is structured. What are the different type of secondary operation we can see in the market? Because I'm not sure everybody is familiar with secondary handle.
Yeah, happy to. As I was saying just a bit earlier, I'm just starting from that number I was evoking, 5 trillion in tech private assets. Half of that are unicorn stage companies, all the well-known names that we have today that have not yet gone public, not necessarily eligible to M&A. Some may go out via PE. So you have one issue left, which is secondaries. We focus more on the VC and growth portion of the market. And the order of magnitude there is that when in private equity, you'll have private equity buyout, you'll have something like 600 billion primary going in every year. In front of that, you'll have something like 20% going out in secondaries. So that's roughly 100 billion or more. Opposite that, for VC and growth, it's twice as less going in primary, so it's roughly 300 billion. And in front of that, you'll have something like 4 to 5% in secondary transactions. So it's 14, 15 billion. So there's a 4 to 5x difference there. So definitely in that portion of the market, there's a lot to be done and there's a lot of growth ahead of us, but there's also structuring take place. And so what we see is 3 kinds of transactions, the direct secondary transactions, which you specialize in. What we see in on the portfolio side are 2 different types, LP-leds and GP-leds. LPs will be looking to sell portfolios comprising of different assets. You can have a combination or a subset focus on typically VC or growth. So that's the first set, and that's roughly 50% of what we see in our deal flow today. The other 50%, so it's pretty balanced actually, is GP-leds. GP-leds can take a number of different shapes and forms. You'll have a situation where it's working on one single asset. Sometimes there'll be a strip of assets within one fund. Sometimes there'll be a whole fund, or sometimes there'll be a sprinkling, taking assets throughout different vintages. So there's a lot of ways to address that. And I think GPs are now being asked by the LPs to be much more proactive in money management, to be able to consistently have a volume of liquidity secondaries going forward, because to kind of translate TVPI into DPI. And that oftentimes is a conversation not only with your own LPs to understand what their objectives are, what they would like to see, what their horizon frames are, but it's also exchanging with the market to kind of understand what the levels of interests are. Typically on one single asset in direct secondaries, that can be one circumstance. And also working with some of the brokers, intermediaries that are in the place. So it's really a conversation to be had on all sort of these 3 fronts, to be able to then either make the most of a situation where secondary can be done, or to proactively build a vehicle, an SPV, and then you can look at all sorts of different geometries there. You can select a number of assets. There's so much you can do.
Excellent. Alan, so the secondary market has evolved a lot after COVID, I would say. Can you explain what you've seen, the trends, and how the market has evolved since COVID? Because before COVID, I would say secondary, or at least the way to transform TVPI into DPI was by IPO or M&A. So I think there is a market contraction, but it would be interesting to have your perspective on that, and why secondary market is going to be a strong appetite at the moment.
I think I'll actually start with why. What you really have is a structural problem where you have a bunch of assets, and secondaries can get very boring, very kind of technical, so I'll try to make it. You've got an enormous amount of great assets, but no cash. And it's a global problem. It's the UK, US, everywhere. And people were kind of trying to solve that when the IPOs were happening. But then after COVID, exactly that, IPOs stopped happening. In essence, the window didn't really open. There's a little here and there, but there was no flood of IPOs. And we can discuss it further. I don't think there will be. And that created a pressure in the system that you had to do something. And out of that, we're starting to see really players try to make that into the PE continuation and this type of tools. And some of them worked, but most of them didn't. And that's where the secondaries started exploding, because on the cap tables of those top companies, there was not one huge PE fund. Thousands of employees got shares. Thousands of family offices had those shares, angels. So the cap table under pressure wasn't institutional. It was people that needed cash. They needed cash relatively fast. And that pushed the transformation into the direct secondaries, platform brokers, anybody that you could see in this 50% a year growth ecosystem, that pushed it into it. And that's where we are currently. Technology then started interfering a bit. I mean, not much here in Europe, but in the US, about 30 to 40% of all flows are platform-based. The platforms are moving now meaningful amounts. It's not only funds. Yeah? And we see platforms building their own funds. We as a fund build the platform, and then there are some platforms building the funds. So the technology is starting to intervene in this. So this is a growing ecosystem, and driver for it is basically just needed a liquidity. You can't, I mean, Klarna, most of you know, 21 years old till it's IPO'd. It's very hard for a even pension fund to wait for any liquidity for 21 years.
Can I just echo one part of that and disagree slightly with another part? So I've spoken with my private securities market head-on to all sorts of types of investors, from very large PE through to smaller, to VC, to family offices, to sovereign wealth funds. Equally, I've spoken to companies. I have a lot of colleagues of mine, and I'd say the resounding theme, especially on the investor side, is the need for liquidity. And actually, if you go to a family office, it's more the need for deal flow. So you can see the pent-up demand for secondaries. Where I'd qualify the second part of what you said a little bit would be this. On the company side, we see a lot of companies looking to utilize this market, many of whom, it's not so much that the IPO markets are closed, they just don't want to list. And that's absolutely fine. The private securities market, it does not need to be some on-ramp to listed markets. If they want to do that, they can do. But the fact is that companies have been private for a while, they're happy being private, yet they have some early stage investors and often loads of employees they want to give some liquidity to, and that's where the demand comes from. Actually, on the markets being open, my last firm investor, together with others, they've just raised £1.3 billion for Rosebank, the second issue. I think the same week, or maybe the week after, they raised £80 million for Videndum, a £10 million market cap company. So 100% capital is there in listed markets for the right companies. And you, of course, I would say that with my LSE hat on, but it's true. But I see this pent-up demand for liquidity. We set up the private securities market because, frankly, companies don't need necessarily or desire, in this day and age, where companies are staying private for longer, to always list.
I would say, actually, to add on this, the understanding of what secondaries is developed massively over the last 5 years or so, and has really over 15 years as a market as a whole from the US and now in Europe. But the understanding that it's not a bad thing for a founder to sell some shares at a point in the cycle, as the company is maturing, it's really not bad. GPs can understand why they might want to do that. That they're paying school fees, or there are various other pressures, cost of living, etc., and actually releasing a little bit of pressure on the founders themselves, on their sort of home life and just generally, is actually a good thing. It allows them to relax a little bit, become a bit more comfortable, and ultimately run a business better, rather than making rash decisions or sleeping less and all of these other things. So I think there are additional things behind this as to why the market's also grown for it, and that's really important.
Yeah, interesting. And so you talk a lot about the company-led secondary transaction, but Romain, it would be interesting to have your perspective also, because I know that a lot of institutional investors, they are also locked because most of the time they invest, they are private-ended funds, so they have to get back the money after 10 or 12 or 15 years in worst case, but they have a pressure from their own LPs. Most of the business model of GPs is to raise money to sell the management fee. So at some point they have to raise new money, and the LPs at the moment they ask them back, but you have not paid the amount I've invested in your fund, so I'm not going to invest now. So I think there is also this kind of pressure in the market. How do you see that, and how do you, because I think you are more on the GP or LP-led transaction than on pure direct. What's the balance that makes you focusing on this area than the other one?
Yeah, there's definitely a lot of pressure to generate liquidity. And effectively, I mean, back to what you were saying, Klarna took 21 years to go public. Many funds are raised with a 10-year horizon. We know it's more going to be 10 to 12, and actually in many circumstances when looking at the data, these funds will have 14 to 17 years of existence. So at some point you need to have some form of liquidity, and prior to COVID, it did feel that many managers just saw liquidity would take care of itself, and that eventually you'd have an exit in some shape or another. Now they've had to be much more proactive, and I think LPs, fund allocators are much more cognizant of that aspect, and kind of will spend much more of their diligence looking into funds, looking at obviously at the team, the platform building, the money management skills, but also how actively liquidity can be generated, and that has different dimensions. If you're on an early stage fund, not an early stage, I'd say more of an emerging manager, which oftentimes will be at the early stage, you'll have liquidity opportunities early on. If you have a big takeoff on one of your companies suddenly kind of reaching unicorn status 2-3 years in, oftentimes you'll have opportunities to sell a portion of that line. And when in the past, perhaps many would have said, no, I believe in that company, I want to kind of keep that exposure to the upside, many more are now kind of looking at that and thinking, well, it probably makes more sense to sell a portion, perhaps 1/3, have a level DPI coming in and returning some capital and being much more proactive in the money management, and kind of attuned to the fact that LPs view that in an important light. Then when you look at more, I'd say, funds that are in more prolonged in their investment cycle, that are 4, 5, 6 years in, you'll often have this kind of Pareto that happens where 20% of your companies hold 80% of the value. And it's often a blend. It's a couple of companies, there's a longer tail, but there are a few core value drivers that are there. And creating liquidity there when you're in the middle of the segue. So, I mean, a Revolut, for instance, is not yet looking to go public. There are buyers out there, but it means that you need to interact with them. You need to provide data, do the heavy lifting work of thinking about structures, interacting with brokers, reaching out to buyers. That takes more time. And you need to be equipped. You likely need to recruit a team to be on top of that. And you need to interact with your own LPs to understand what their desires are there. Some may not be looking to sell. Others may be happy to roll over if a continuation vehicle happens. I think the bottom line is that you have to build more awareness, be equipped, have that conversation, and show that you are actively looking at the issue and able to make the most of opportunities when they happen. That's what I think has changed.
Interesting. Will, I want to come back regarding what you say, because I think a lot of founders will be happy and will probably come to you saying, oh, they want to buy my apartment. And but I guess you are probably very selective on the company you are backing. Can you explain a bit the profile of companies that are attractive for secondary transaction? Because I can imagine that not all the Series A, Series B, or even later will be
Yeah, I think, well, if I start on the top end of the market, which is maybe less relevant for the room, but probably more volume of transactions sort of happen there. So I think actually there's a lot of direct secondary shares being bought. So these existing shares in companies, no newly issued shares. These are just existing shares that are owned by family offices, individuals, whoever it might be. And they are being sold to new primary investors, which is actually a big fundamental change to the market of what's happened in the last 3 or 4 years. So a lot of money has been raised into mid-market buyout private equity funds. And those private equity funds are looking to invest into these companies. Now, a company might be raising £50 million, let's say, for their growth round. That buyout fund has just raised a £1.5–2 billion fund, and they need to deploy that capital. So the only way to deploy that capital is actually attaching secondary sleeves alongside the primary. So they might do 50 million of primary and 50 million of secondary. Now that's where the direct secondary piece becomes important and is a component. And the sellers there can be founders, it can be employee option pools, it can be various different mechanisms. And that's really important. So that's what's happening at the sort of later stage element. And as you come down the market, to the earlier stage, this is typically where we operate in sort of Series B, Series C. We can do slightly later, and at times we can consider slightly earlier. Now, I think it's quite hard to do earlier than that because the people that have invested at that point, they're still relatively young in their, a typical GP would be invested, let's say, for 2-3 years at that point, in a 10-year vehicle. They're not looking to sell shares. Family offices are also looking to hold those shares for longer. So I don't think there's that much of a market there, apart from potentially some founder shares. But at that sort of Series B onwards, where companies are at that sort of inflection point, that part of the J-curve where they're scaling the fastest, that's where it's the most interesting for us as investors to analyze these companies. To your point of, what do they need to look like or what's helpful? I think cap tables is something that we obviously look at. Is there any structure there? Do the current investors have liquidity preferences, or is there sort of some weird structure that is going to be more complex for us to understand? Now, actually, I can speak from our primary fund mindset, the seed stage venture business that we have. Actually, one of the core things that we always do when we invest in our companies at the startup level is not to put any structure in, because it makes it so much harder for that company to go on and lead a Series A round or a Series B round or further from that. It's really important to have a clean cap table to the extent you can do that. And then, from a secondaries perspective, the beauty of it is that you can invest at any point in the cycle. There's no need for a primary round. There's no need for any sort of dynamics. So you just can invest in a bilateral conversation with the company directly. And from that perspective, it's just looking at the financials. What has the business done? How's it grown? What were the forecasts of the company? How have they aligned to those forecasts? Have they exceeded them? Have they not achieved what they said they were doing? Why have they not achieved? What have they done to address that? Those are the metrics that we look at. And actually, it's much easier for us as a secondary investor to do that and price that than do a primary round when a company's probably looking at its best, because they've prepared themselves the best, they've got themselves and their story straight, et cetera, et cetera. Secondaries, you can say, well, look, I saw your deck from 12, 18 months ago. You said this was going to play out. Has it? Why hasn't it? Or how have you beaten it? And that's incredibly helpful for us when underwriting.
And Mark, so you, with LSEG, you put in place a strong infrastructure to facilitate those transactions. What were the real pain points? Because I guess it's a lot of investment on your side. So what were really the pain point, and how do you see this platform having in terms of impact?
Okay. The sweeping generalisation of what's been sort of culmination of about 4 years' work on behalf of a lot of people at the LSE and the government and the FCA. I said, I think, first thing, genuinely nothing like this exists at the moment. It's different from what happens in private primary raising transactions, and it's very different from secondary transactions in that disclosure requirements from the FCA are deliberately low, but it's the public market pipes and plumbing. So when people place an order on these one-day auctions, they come in via normal sort of brokers. What's the pain point? It's just creating something which works, frankly. I think awareness, I'm still, getting people saying, well, how do you spell this Pisces thing? What is it? That will get easier. And I think in terms of your last point, the scale, this is a new market. First auction happening this week. I think the indication of success will be actually in a year's time or 2 years' time. I was chatting to Marcus Studdard, who heads up AIM, and he was talking about the early days of AIM, where they I think they had 20 companies on AIM. So I personally think it'll start quite, this is a Mark James view, not an LSEG view, quite slowly as people, we've got we've spoken 400 or 500 companies, a lot of them really interested, lots of them wanting to go second. So you'll see that happening like any new platform-based business, like any new market. I think it'll start relatively slowly, but as people get more familiar with it, I'm in no doubt about the pent-up demand and some of the things we've been talking about here, the need for secondary liquidity. So awareness has been a bit of a pain point. Putting this stuff together, right? So companies choose to do this. Companies have to have a shareholder vote. It's got infinite amounts of flexibility. You can choose your frequency of auction, you can choose your price range, you can choose which shareholder line, to your point about cap table, you want to put on it. You can even choose, if you like to have what we call a preferred auction, which brokers you use and which shareholders can invest. So there's an infinite amount of flexibility to bring it to this point. I think from here, the only challenge, frankly, is going to be awareness.
And I think a point to make a transaction successful is also the valuation. On your side, Alan, I think the transaction on secondary can be, I don't know how you manage to define the prices. Are you defining yourself the prices, or are you using the prices of someone else? So Will mentioned the fact that some secondary happen when a LBO transaction arises. So at this stage, I think you have to use the GP valuation, so the GPs that led the transaction. Is it that simple that, or because part of the valuation is the upside, but also having this room to negotiate some margin that will make your TVPI look better at some point as well?
Yeah, I think in a secondary transaction, pricing is the most interested, because in the primary, it's kind of set between the company and usually, if it's a growth stage, large fund. So most of the funds around the table don't really have much of a say. So how we do it, and actually, that is also an area where I think we have grown as a secondary market. So one is, if you currently look at the market overall, and we consolidate probably around 300 to 400 transactions a day on the secondary market, still mostly US, but some Europeans are coming into that. If you look at the top 15 most liquid tickets, they're still at around 15 to 20% premium to the primary rounds right now. If you look at the rest, average, if you drop below 30, the discounts to primary round are more than 50%. Averaging around minus 11, minus 15% discounts to primary round. So your first anchor for most secondary transactions is still the primary rounds at the moment. That's your first. The second anchor is your tender price. Was there secondary tender? Not. And a lot of secondary funds use tender as almost a primary valuation because it's company defined. But what's emerging, and that's the two prices that we give to our LPs. Here's your primary round, but here's your market-determined secondary price. And we run our own algos, what we call an Oracle kind of feed, but there are also independent providers, which we take into account. There's a couple of them, all US, which look at the median price of what this company was sold at in the last deal. If that company wasn't sold, there was no transaction. Similar companies, and does an algorithm compared to the primary owners. There is only 4 or 5 companies that you can do like this in the UK. I was very happy. Kind of 3 of our investment kind of portfolio companies have been mentioned through this forum. You can do it on Anthropics and Revoluts and Agoras. No, you can't do it on what we call liquidity band D. So we use liquidity bands to determine the price. Liquidity A, continuous bid. Liquidity B, intermittent bidding. And liquidity C, basically nothing. And D, never even seen secondary market. So we try to kind of separate that. So we do have what we call a liquidity price now, but it's mostly for the A and a little bit for B, which is in the UK, maybe 10 companies in total, which will bring this up. That's the valuation, but it's moving fast. And it's moving fast into a direction that the market is becoming very top-heavy, consolidated. So if you're a top company, you command a premium. And if you are at the bottom, and I think very much, right, Mark says, there's no awareness of the company. Nobody knows about it. The company might not know about secondaries. Discounts are quite steep.
One point that I'd add on that, and very briefly, is share class. So obviously that's going to affect valuation quite considerably.
That was my next question. Thank you.
So yeah, I mean, that is, as a direct secondary buyer, that is one of the sort of primary considerations that we look at. However, in a lot of situations, we will buy common shares that get reclassified to prefs, which is extremely common, and it's just all part of the negotiation process with the company.
I think I know I'm talking my own book here, but one thing based on demand-led, liquidity-led pricing, I think it's going to be really interesting with this new private securities market is the company sets a high and low valuation parameter, and they have to say what that is, but that could be really wide. You could just say, right, I'll have the top end as a multiple of revenue and the bottom end at NAV, or it could be really narrow. What we do with the infrastructure is that we take the buy and sell orders. Buy and sell orders outside of that range, get rejected. And then there's one price calculated by, please don't test me on this, it's the same algorithm that's used in market open and market close for the listed market, determines the one price at which the shares change hands. So it's genuinely demand-driven pricing with concentrated liquidity in these one-day auctions.
Yeah, but that's also the challenge in this environment where, because in the cap table, most of the time of those companies, you have GPs that want to get the control of the valuation because then they have to release a report to their LPs with a proper valuation. And I guess if the valuation, so will you have different kind of strategy, and primary is one of them. I guess if you have a secondary fund that is communicating on a valuation that is totally different on the upside or on the downside, I guess, it can be problematic at some point. And how can you mitigate this kind of risk, and how do you, is it the control of this information is something important, or at the end not really?
Yeah, I think it's slightly easier for us than it is for maybe Roman. We obviously determine when we want to buy the shares. We're speaking to the company's CFOs, CEOs, etc. We're having direct information from them, full information rights, etc. So it's slightly easier for us because we can do it, and typically we do it off IPEV valuations, so International Private Equity Valuation Guidelines is what it stands for. Lots of silly acronyms in private equity. And yeah, so it's much easier for us, to be honest, because we can look at public market comparables and go by the guidelines to set our valuation. And then obviously feed in a liquidity discount relative to those valuations. I think maybe Roman's probably the best to comment on this because it's definitely the toughest for them because they obviously receive LP reports.
Yeah, I mean, there's definitely an asymmetry of information. I mean, I guess the way to look at that is just to look at it from the buyer perspective. When you're looking at these portfolios, when we're buying up not a single asset but an array, so we're looking for diversification. We're looking for a number of key assets that we can underwrite to, and that we have information, access, some data to be able to kind of converge on what the right valuation can be. But effectively, in the end, what you're looking at is you're not so much on a multiple strategy, you're on an IRR approach. So you're looking at the time frames within which liquidity can happen for certain of these assets. If these are funds that are 8 years in, usually you start seeing the first liquidity events coming around immediately or in the next 24, 36 months. So that's the first thing you're trying to bake into your analysis. The other aspect there is what kind of growth do these underlying assets still have within them. So you can be in situations where the net asset value sort of marks at which these companies are held within the portfolio make total sense. But that means that if there's very little growth, the only way to reach a transaction that makes sense from the buyer perspective is to bring in a discount, which will be reflecting the lack of liquidity, but it also means that that is the surface area where you can build a return. So you oftentimes have to expect that discount, and it's the name of the game, but it's also healthy to have that price discovery taking place. And I think LPs are very attentive to that. We've had many situations where LPs weren't holding the assets at their NAV on the books. They were holding them at cost just because they're not quite sure if the marks there are reflective on the underlying portfolio value. So you can't hide away from valuations by just blocking any secondary transactions, because that just then creates defiance, interrogations, and that never helps when you're looking to raise your new fund. If you have 2 or 3 funds that have no liquidity, held at a certain TVPI, and there's no secondary transactions to back these marks, then you're not in a good position to be able to raise a new fund. So you have to confront the market at some point in time, and that's just the way healthy financial markets deploy themselves.
And last question, because I come back to you, Alan, but on valuation, so you have one way to determine the valuation is the comps and all that, but preferred stock also determine the valuation, because if you are the last round if you are just a common where you have 3 or 5 rounds of preferred above you, then the valuation of your common, if the valuation stays steady, maybe it doesn't work a lot. How do you see that in your approach? I can imagine that it's part of your initial work, but
yeah, look, I think the way we look at this, first of all, preferred stock is ultimately a risk management tool and not a growth by itself. It's a defense. It's not a growth driver. So the way we see it, if we believe that the company is under big threat of multiple compression, and for example, a lot of companies currently are, and this is the biggest thing that we look right now on the valuations, that preferred stock really matters. Because if multiple compresses faster than the growth happening, that's it. That's happening to fintechs right now. You can see it in publics, you can see it in privates. It doesn't really, unless you're number 1 or number 2 fintech, the rest, multiple compression is the life, that you are living in. So that's where preferred stock really matters. If it's extremely high growth company, and I don't know, we invested in one of the top LLMs 2.5 years ago, there, less, because this company is growing at 300, 400,000%. And in this time, you are buying into growth, but what's important right now, you're selling back into private markets, not into publics. Because from our portfolio, let's say most recent fund, 24 vintage, more than 50% sold back into private. 2 equities ends, 2 Morgan Stanleys, 2 this, not into public, although we had a couple of IPOs, because multiple in public versus multiple in private, huge difference. So the exit for our LPs, and ultimately that's who we look after, is better in private. So preferred, yes, but preferred is more of a defense. And since ultimately secondary or primary, we run a growth fund, it has to grow. If it doesn't grow, it doesn't matter what discount you got, really. The discount would justify it, maybe 70% of it. So that means we use it, but that's not the first what we look at.
That's a totally different perspective than the private equity secondary fund that just pay on the discount and this is taken into consideration. Maybe it would be interesting to hear from you. I think, Astrid, we are out of time, or are we still good for? Yes. Okay, so yeah, I think it would be interesting if we can hear each of you saying what would be if you can give an advice for a company, for the 3 of you, and you to GPs, Romain, what would be the thing to consider before starting a secondary transaction? Alan, do you want to start?
Yeah, I think the big war right now is for talent. You need talented engineers. In cybertech, there is a huge problem with really people knowing how to LOI. Secondary tender and secondary market, that's how you can pay your best people. Now, without calling equity money. So this is what we see all over, for example, US and Europe has to it. This is an amazing mechanism for your company how to remunerate your best employees. And that's probably my advice.
Yeah, I definitely agree with that. I think, think about, secondaries, yes, is potentially great for creating liquidity for yourselves or for your employees and remunerating them. But think about, A, who the seller is. Have you got a group of angels that are exiting your business? Who is actually giving that liquidity in the company? But also who's coming in? Who's buying those shares? Because ultimately you're going to have to report to them. They're going to be shareholders in your business. Depending on how much they're buying, they're going to have influence on you. They might get board seats, all of that. So think about, yes, who's selling, but ultimately who's buying, because they're going to be in bed with you from that point onwards.
I definitely echo that. Be very, very clear about what you want to achieve. We must have spoken to 400 or 500 companies, and the use cases, some of them are obvious, so been private for a while, never wants to go near public markets, early stage investors. We've spoken to companies that say, look, we hold annual auctions with thousands of employees. Frankly, it's a complete pain in the backside. We've spoken to founders that still own 100% of the business, but they want to free up some liquidity. So be very clear on what you want to achieve, and to Will's point, the shareholders you want on board. Do you want thousands of small passive investors, or actually are you doing this transaction because you want to narrow it down and narrow that focus? So let's be very, very clear about what outcome you need to achieve, especially going back to this market, because those levers are available for the companies to pull.
My advice at GP level is to be very deliberate about your secondary strategy, to have an active money management framework in place internally. The same way you make decisions to invest, you need to have an internal process to think about divestments. Are you making the most of certain opportunities in a reactive way? And so you need to have that framework in place. You need also perhaps to have the interactions happening with founders, with the rest of the cap table, because it can sometimes be first come, first served, especially at the early stage. And then you need, that's on the reactive side, and on the proactive side, well, you need, it's hard work. You need to have someone working on that, working on the portfolio, on the key value drivers, to have your data prepared, to have an ongoing dialogue with your LPs, to have the connection with the brokers out there, so to know what the market looks like. There is a market timing effect. There have been windows. Valuations shifting in the public markets. There's no reason they won't shift in the private market. So you need to be aware of that, and you probably want to have a long-term mindset here, just so that you're not put into a situation where you have to sell into a situation that is probably not as optimal as it could have been a few weeks back, a few months back. And then on the LP side, same thing. I mean, if you're looking to create some liquidity, you need to have your ducks in order. I mean, we had a situation last week where we had an interesting portfolio came through, and we had a discussion over a few weeks, kind of reaching a price point. Then we found out in the kind of last minute that there had been some mix-up in certain of the funds. It was not Fund 1, it was Fund 2. That was okay because we knew the platform and we'd underwritten the funds, but there's a bit of work to be done there. Potentially, if it's sizable enough, reach out to certain brokers who are able to guide you, assist you, at the very least, on some of these larger transactions, or one of the smaller ones that can kind of help you, giving you guidelines or connecting you with the potential buyers that are out there, because they're not that many. That's, I think, my conclusion is that it's really a specialist's area, and there's a big mismatch between offer and demand, and there are not that many players right now with the dry powder to be active in the space.
Excellent. Thank you very much. I hope that you've enjoyed this panel. Thank you very much for your nice advices, and I think it's time for having a lunch. Thank you very much.
Thank you for having us.
But anyway, thank you. Thank you all for being here. I mean, I'm sure you'll agree that was a really lovely lunch, and it gave us such a great opportunity to catch up with each other. It's a real pleasure to be here. I'm Hamaxi Bat. I'm one of the investment specialists on the Investor Partnerships Programme with Innovate UK. Some of you will already be aware of the Investor Partnerships Programme because we're working with a lot of you already here, and I'm just going to go a quick run through of the programme, and any questions I can deal with either during the slot or afterwards. So what is Investor Partnerships? This programme was designed to accelerate investment into innovative UK businesses. I mean, as a lot of you probably know, that innovative businesses face a dual challenge. One is very much around that support to develop and validate your innovation, and the other is around raising capital at the right time to be able to scale. And we were talking about that this morning, for those that you were around, about how difficult it is to get the two together and getting them at the right time. So what this programme does, it helps to bring those elements in together in a much, much more coordinated way. On the one side, Innovate UK grant funding is there to support that early stage R&D. So that includes not only an independent assessment of the project, but it also looks at that non-dilutive funding and an ongoing monitoring. And then the other side, investor partners, like many that are here, you bring that sort of commercial expertise and the capital, and you help identify those investable companies and provide that equity finance and offer access to markets as well. You're really playing a key role in shaping and supporting the commercial direction of these businesses. So the real value of combining these strengths by aligning grant funding with investor engagement early on is that we can maximise the impact and reduce risk from both sides. So I'm not going to talk through the slides. I've just sort of spoken about that sort of high level. But really, the Investor Partnerships Programme is just about accelerating growth, accelerating investment into those businesses with the support of public sector funding, the grants, and private sector funding from you as investors. Let me tell you a little bit about the impact the programme has had so far. Started out back in 2017. It was a pilot. We went through COVID, and it's really evolved since then. Programme has been impactful. And if we're starting with scale, we've so far supported 443 investees through the programme. These are really innovative businesses right across a range of sectors, all developing new technologies and solutions. And to enable this, £184 million in grant funding has been committed, with 132 million of the 132 million already deployed into those businesses. So as you can see, it really reflects a strong delivery as well as that continued progress through the portfolio. What's particularly important is the level of private sector engagement. We've worked with 109 investors. These are our investor partners, and showing sort of that breadth of investor partner networks and the strength of the collaborations that we have with them. That collaboration is translated into real capital for those businesses. We've seen 486 million that's of aligned investment, and so that's actually investment that's coming in alongside our support by way of the grants. And overall, the programme has helped leverage 1.93 million in total investment raised. So quite substantial figures there. It really does show the sort of catalytic effect of the programme, using public funding to unlock that private investment. So what I really want to say, I think the key message here is the programme is not just about supporting innovation, but actively accelerating investment, crowding in private finance and helping businesses scale faster. So what are we looking for? Just before I go into that, I'm just going to talk a little bit about the growth catalyst competition that's really recently closed. We're still going through all of the applications and sort of selection criteria, and I think notifications have gone out. So hopefully there's some of you in here who've got some businesses that have been successful. But just to give you a quick overview on that particular programme, of those applications that we received, over 50% of those applications nominated by an investor partner, 60% of those are moving to the next stage. So what we're looking at is, I think we've made a commitment of just over 100 million to over 200 businesses. Really now we're going through the process, selection bit's done, and it's really very much about working with those companies as they come through and where they're at. What were we looking for in those applications? And though there isn't an investor partnership programme launching in the near future, as Scott mentioned earlier this morning, our strategic prospectus was launched just last week. So we're now working on we're looking at optimising our processes and aligning them with what's within that industrial strategy with our new strategy. And the intention is to have a new competition launching most likely during the summer. But what we're looking for within those applications when they come through is what you can see here. So we're looking for ambitious companies that are actively seeking investment and have got clear plans to scale. The innovation really needs to be backed by a well-defined R&D project. So not just an idea, but structured and a credible programme of work. Applications need to demonstrate a clear alignment to the competition themes, ensuring that they are within the relevant priority areas. So each of our competitions may change, but it's really, really important to look at what's behind them. And so this is really an overview of what we're looking at. But I would stress, when the competition launches, just to have a review of the terms and conditions there. I think the key thing is, with all the investor partnerships programme, is that we expect to see an established traction with an investor partner. That early engagement is a strong signal of quality and it helps validate the opportunity. Overall, what we're looking for is businesses that combine strong innovation with clear commercial potential and credible investor interest. Okay, so when we're looking at that funding decision, though a lot will depend on the themes and things, the things that we will always focus on is the innovation quality, additionality, and traction. So where we're looking at the innovation quality, that is assessed by the innovation lead for that particular sector, and it needs to be a highly innovative project that they're looking to bring through. And then when we're looking at the additionality, what we mean by the additionality is where the grant is concerned, we're looking at that leverage. So the investment amount versus the grant amount. Is this a new investment coming through? Is this a follow-on investment from yourselves? What's that proportion of investment? And really the key thing is really the evidence of impact of that grant other than that commercial benefit. So additionality, is the grant going to bring in additional aligned investment? That is the key point when we're talking about the additionality bit. And then traction, when we're looking at the traction, it's really what's the stage of completion? What's the likelihood of that investment? Will that complete in a reasonable timescale? So 90 days. Traction could fail if, not looking to raise that funding, or it won't complete until 12 months down the line. So that could count against a potential application. So it's the stage of completion, the level of commitment, looking at the level of support, clarity around the syndication and commitment. Already mentioned about the timeline to close the investment, and what are the conditions. Obviously, that's really, really important as well. So the specific areas of focus. Now here, I'm really talking about the growth catalyst competition that just really finished, and all these areas are from our industrial strategy, and though it's the key sectors around advanced manufacturing, clean energy, creative industries, defence, life sciences, digital and technologies, you're all going to say, where's professional business services in this? So just to explain, though they're not here on there, but within our recently published prospectus, it makes it clear that professional business services remain an important part of the innovation landscape. But the approach that we're applying is slightly different. The primary focus is on these key areas, and particularly sort of things like digital and technology, particular frontier technology like AI and cybersecurity, all those things that we were talking about this morning, that we were hearing about. And basically, in practice, what Innovate UK is supporting is innovation in these sectors where the technology is applied. So those professional service businesses, though we haven't got us a line that says that, but obviously from lots and lots of conversations this morning, AI comes in, cybersecurity, it's an enabler. So that's where the focus is with the professional services businesses. We know how key it is to press things forward in those sectors. And I thought I'd just give you a quick overview of how the funding works. There's every chance that this is what we will still be looking to fund when we do the next one. But this just gives you a bit of a feel for what the numbers are. And so it depends on what the research category is. And we have feasibility, we have industrial research and experimental development. So as you can see, the project sizes all vary, and the amount of the aligned investment that we would expect from an investor varies as well. So if you're looking at feasibility studies and industrial research projects, the actual project size needs to be between 50,000 to 300,000. And the grant that could be available is up to 70% with a project duration of 6 to 12 months. But the investment that we would expect from yourselves or as a syndicated area is at least equal to the grant funding. Yeah. And then similarly with the industrial research, very similar, except that the project duration can be up to 24 months. And it's really where the experimental development comes in that the figures are slightly different. So project sizes we'd expect to be bigger when it's looking at experimental development from 250,000 to 2 million. The grant available is 45%, and this is where we would expect the aligned investment to be at least twice the amount of the grant funding. So just really to give you a bit of a feel for what we're looking at funding-wise. And as I said, it was sort of a bit of a whistle-stop tour of the Investor Partnerships Programme. But thank you, everyone. Thank you so much. As I said, I'll be around if you've got any more questions. Okay, thank you.